What's up, everyone? I hope you're doing well. We're going to be talking about options trading today. This is not financial advice. Trading invest at your own risk. And as always, always do your own research. Never rely on someone else because every circumstance and situation is very different. So I'm going to try to make this a very simple, easy to understand video on options because there's a lot of videos out there. And a lot of people get confused or feel a bit intimidated by options. First of all, options trading
Is it
is
done yet?
inherently far less risky. Sorry, I was interrupted and got distracted. Options trading is inherently far more risky than just buying a security, right? Because that security is never going to expire. So in theory, you can just continue to dollar cost average, and then sell whenever you want to sell. Your option, on the other hand, at some point, if you're wrong about the direction of the stock price and it expires worthless, you're going to lose everything. So a lot of people have been devastated by options trading. And it's something I advise you to start small doing, and that way, if you do fail, you can learn from those failures. There is a high cost of learning, trading and investing, and the high cost is making mistakes and failures. And the only thing that separates everyone from the few that succeed is that they just never give up. Everything I've done in trading and investing, I've had a lot of failures, in the past, and at times I would recognize big losses and reassess and reallocate the funds, whether that's a wash sale, whatever the case is, because it seemed like I was hitting a brick wall, so I had to do something. So in the case of options, you may do an option rollover, where you pay a really high premium to roll your options to the next month, right? If it looks like you're just going to lose a lot of money. So one of the things we need to discuss is theta decay. So the closer your option gets to expiration, it's going to suffer theta decay. So what that basically means in simple terms is your option is far less reactive to the price movement of the security. And that's a big problem because options greatly diminish. If you're wrong, it's going to move down a lot faster than the stock price moves up or down, depending on whether you're have a call or put option. So first of all, you need to understand theta decay. The number one reason that most option traders fail is because they don't give themselves a long enough expiration date. And when you're giving yourself a long enough expiration date, it doesn't mean that you're going to hold that long. I've had people say, well, I don't want to wait 3 months to get paid on this. It just simply means that we are avoiding becoming a victim of the theta decay, which is the number one failure among options traders. So that's number one. Number two, we want to look at the strike price. What strike price are we choosing? So, for example, let's say you're wanting to get a put option on SPY. You do the $280 put option. Now, let's say that put option, doesn't expire for 3 months. And let's just say near the end of March, let's just say we end up dropping down to $350. Um, you're going to make a far less premium than someone whose strike price is $350 because they're closer to being correct. Now, you can exercise your option, and a lot of people are confused because it says you are agreeing for every option, to buy 100 shares of the security when it reaches that price. Some people are thinking, oh my gosh, I can't afford to do that. Well, most of us are selling our options just outright. When it's in the money, we're selling it. So that's another thing we're going to talk about is the delta on an option. It's important to look at the delta. When you look at zero point 0.5 for a call option, negative zero point 0.5 for a put option, that means that option is in the money. Now, when you're looking at 1.0 on a call option, that's deep in the money. Negative 1.0 on a put option is deep in the money, right? So obviously these numbers can go much higher in either direction, depending on if you have a call or put option. Another thing you want to look at is the open interest. I consider 30,000 to 50,000 to be a healthy open interest. It means there's enough people buying this, to where the price just moves better. And sometimes you'll see a spike up, and and it spikes right down. So I do want to clarify that many times I have had the option skyrocket and my account goes to insane levels, and I will have had a limit sell set, like, let's say it goes here, my limit sells there. It won't always hit. Options are very fickle. Um, it's possible that it could hit. And before the video is over, I would like to discuss some disasters that have happened to me, option trading, and even in stocks, just something for you to look out for. But first, so I want to talk about picking the right strike price, right? So you're going to pay a lot less money for the $280 put option. However, it's not going to uh, move up in a big way. Let's say we get to 350, like the $350 option, right? So, in my opinion, you should pick a strike price that represents where you believe this security will actually go. Now, in some cases, for example, there was a time when Neo, I think it was about 25 or $30. Now there's a lot of people buying the $100 call options now because those were so cheap. That worked out great for people. So again, every situation is different. It's really important for you to do your research, and when you start out option trading, you don't have to invest a lot of money. You don't see how you do, and really you're going to learn by making mistakes and failing. That's the best way to learn. It's been the best way for me. I've made a lot of mistakes. I've had some massive failures. Some were my fault, some weren't. But the point is, it's important to understand how these things work. So another thing I want to talk about. Let me see if I think I covered about everything. Kind of again, I'm just skimming the surface here, but I want to tell you about something that happened to me with stock ticker PCOM, and which is points.com, and Stone, which is Stone More, STON MOR. So I seen that these securities, they just really got juiced up, and for example, points.com. There was a time I did this on Tenneco as well and did good on that one, researching, is this company struggling? Is this, we have, people that want to make money on the way up and way down, right? So when we're looking for strengths and weighing company fundamentals, and we're looking at ROA, EBITDA, all these things, right? We want to, and I'm sorry, I'm having some distractions here today. But so we want to research weaknesses in companies just like we do strengths, right? Because we want to make money on call options or shares, but we also would like to make money if we think a company is performing poorly, their earnings are dwindling, they're doing layoffs, they're having problems, whatever the case is, right? If we feel that security is far juiced up beyond where it should be, assuming it's not a highly volatile meme stock where there's just a whole other factor of risk due to extreme volatility. So anyhow. So I went pretty heavy in points.com put options and Stonemore put options because I'm like, we're looking at an economic downturn, and these prices are going to drop. So I was right. My account increased substantially, and every time I tried to sell, they wouldn't let me sell the options. Next thing you know, I get a message that says due to corporate action, something like these options have been frozen, right? So I couldn't do anything. And the next thing I know, they just pull it from the market. It's gone. Poof. There goes your money. Every bit of it. It is gone. It's kind of like similar with Party City. You're buying in, you're thinking, man, we could get this thing up here. And just like I talk about when I first started doing these videos, is the first thing you have to realize is the stock market is like a casino. It's all set up to take your money. So that's the first thing you have to understand. And if you don't get that, and you don't get the manipulation and corruption of these scumbags like King Griffin, the market makers that are controlling this and rerouting buy orders to dark exchanges or dark pools while they're rerouting sell orders to the lit exchange, and the many various ways they're just out to screw us over. When they screw us over, they make money, and that's just something you have to realize. So anyhow, let's say you bought Party City. Super high volume, you're looking at, I believe it was 700 million. Don't quote me there, but so you're like, man, I think we could seriously have a run, right? So they say, nope. You know what? We're halting trading. If Ryan Cohen's investing in Bed Bath and Beyond, we won't halt trading, right? Or I think it's great what I've seen with GNS. That's been really great for people. Or if you look at AMTD Digital, how can something go from a penny stock to $2,555 within 30 days? Well, somehow, miraculously, it didn't trigger any circuit breakers, because it was the right people invested in the stock. So people like us, these retail stocks, we're getting hit harder. So always diversify your portfolio. And whether you do this with option stocks, both, whatever. I've had people ask me, like, what's a good number of securities to own? That's up to you. It depends on the size of your portfolio. However, I found that I do better if I plant around 50 to 60 trees, because I get harvest on this tree and that tree, and I pull it. I've made money on this. I pull this, and then I buy this one. It's a constant rotating window, constantly working, constantly researching to figure out, where am I going to put my money next. That's why I research so many companies. I actively track around 200, and I try to keep up with around 300 different stocks. And again, that works well for me. I target generally buying only during capitulation, only when the stocks went up, depending on the stock, 200 or 300%, right? And a lot of times I'm out, and then sometimes I'll keep some of it to run. But the point is, I generally like to, let's say I've made a profit, allowing me to sell X amount, and the other X amount I keep is absolutely free because it doubled. So that's another strategy. And if you double your money, you still have to leave the investment, then that's a free investment every time you do that. So that's another strategy. But I just wanted to mention that because not a lot of people, but I've seen, people will FOMO into something, and that could go really good or it could go really disastrous for you. Um, it's a lot easier, in my opinion, to predict price action. A individual stock and those investors, the price action, how that stock generally moves. It's a different animal. So I'm going to give you an example of another thing to look for on options. So when we were looking at January 20th OPEX, we had options. For example, a lot of options on SPY. The open interest was around 160,000, give or take. Right, that's a very high. It's a very high interest. It's a very high open interest. So market makers, they understand that if all of us retail are correct and they allow the stock, SPY, S&P 500, whatever, to drop, they're going to owe a lot of people a lot of money. So what do? They artificially pump the stock. The market makers keep the market pumped, right? Or they hold it sometimes steady and flat. So they burn call and put options holders. Again, at the end of the day, the goal is to screw you over. So that's why I say you need to allow yourself plenty of time on put options. Had people had March expiration dates, they'd probably be well off. But the reality is, people either lost everything on January 20th on their put options, and there was a lot of retail. We reached a record level, in that. Bears being so high over bulls. So again, did you take the loss? Did you pay a very high premium to roll over your options to February? Where, even though there's been somewhat of a balance between calls and puts, if you look at the ratio, um, you know, they understand, they want to burn these bulls too, or I'm sorry, bears too. That's why we're seeing SPY move up. Does it make sense? No. If oscillators, if you're a technical trader, you know how to trade MACD and all these things. I don't care who you are. You've probably been a bit confused with the movement in SPY. It doesn't make sense. They've been keeping in this mixed signal zone, and a lot of times it's moved opposite of what technical signals suggest. And that's why you can't go on technical signals alone. You need to look at put call ratio, and you need to look at volume. For example, we need selling volume to come in on SPY, and it just hasn't happened yet. Now Wednesday we're looking at a rate hike, and I realize I'm getting off from options specifically here, but it's all relevant. So I believe the market's going to tank on Wednesday, but how low is it going to go? I had shared a chart showing, I believe it was 372. It suggests we could see a bounce. If you look at the indicators in the market now, it looks like we may not actually crash until around May. So the point is this: had option traders been willing to pay a higher premium into March, they wouldn't have lost everything they put in. And I'm sure we've seen certain levels of short covering, etc. Recently, data has shown that institutions have been selling and retail has been buying. Right. So is it revenge trading? Is it trying to recoup the losses? Whatever. The point is, it's highly volatile to short because you cannot predict SPY like you predict a particular stock. We've seen SPY moving up when its holdings were down, and that was my concern. What happens when SPY's holdings start going up? So it's a big problem. But I also feel that we're going to have an even larger flush when we do flush because of this. The Fed is trying to keep everything propped up. Again, everything has been spiking, coming into FOMC. So it's the action is not a huge surprise. However, so let's just talk for a second. what are these option holders going to do in February for the February OPEX? Because they've already experienced massive option theta decay, right? So are they going to roll them over again into March? Could we hit extremes again? I don't think so. I mean, the longer we go on, retail loses more and more money when they feel that collectively retail doesn't have the money to short anymore, or they're just so bullish and call options, the ratio is higher for call options. That's when they're ready to flush. They're ready to flush when no one's going to benefit on it but them. All right. So again, that's something to look out for. And me personally, I do far better. Uh, with my long list of stocks, I know how they move. I know the catalysts that are upcoming, positive or negative, and I understand what that equity is likely going to do. And when I'm doing equities, I don't have time to do videos all the time, but I can generally predict always where to buy and where to sell. And I'm always very close. It's a different story with SPY because it's heavily manipulated by very corrupt people. So I guess that's all I really have for that. So just to kind of recap, pick an expiration date where you won't be so pressed. Like right now, if I was getting some puts, let's just say $350 puts on the market, I really don't want those expiring until May. That's just me. Do what works for you, but it's just one of those things where you have to make the ultimate decision. And even if we flush Wednesday, how low are we going to go before we bounce, right? So just something to keep in mind there. And again, theta decay, most people's mistake is they suffer theta decay, and people have options that expire, in a day or a week. And if you're right, sometimes these things can work in your favor depending on the situation that you're doing. But again, keep in mind the expiration date. It is really crucial, along with the theta decay, the delta. Look at the open interest. Again, if you're seeing it at extremes, to me, it's a warning sign, especially if you're investing in SPY. So I guess that's all I have for now. Again, I know this is a long video, but I kind of wanted to skim the surface there, and not get super technical on you, because I think it's intimidating enough as it is, and it's fairly simple. It's really not that intimidating if you follow those simple steps. And if you knew at options trading, for example, like you may have wanted to wait to buy call options until Bed Bath and Beyond is at a couple bucks. And there's a lot of examples when Carvana was at like 5 or 6. You may want to wait to buy your options until extreme levels. Maybe you're waiting until to see if SPY touches 410 again. Do you want to hold those options until SPY gets to 350, or due to volatility, could you possibly earn more by selling them around 367 to 372? Get out, make your money, and even if it goes lower, a lot of times we'll see an initial spike. This security's following, the option rockets up, and then it'll balance out. We'll start seeing decay in the option, and then even though it goes lower, you end up sometimes getting less. So that's just what works for me. Generally, I'll sell on a really heavy volatility wave if I've made a good percentage. I don't get greedy. I guess that's all I have. Again, just looking over the basics of options. Do your research, because options trading is much more risky than buying stocks. And there's all different types of options, which I'm not going to get into because I think it's something it's a lot to cover. But you need to do your research on the types of options and exactly what that means. But it can be very profitable. People that need to build up their account very quickly, you can make a lot more money a lot faster. You can also lose a lot more money a lot faster if you are wrong. So you better make sure you're right. If you buy a call at a capitulation level, or a put option at an extremely overbought level, maybe you see triple negative divergences and you think, man, it's time to go down. If the case with SPY, it doesn't mean it will. But again, if you're playing an individual company, an individual stock, you know the company, you know the stock, you know how it generally moves, it's going to be, in my opinion, far less risky. That's pretty much all I have. Any questions or comments, please feel free to let me know. And just always remember that they are after you and your money. and they employ a lot of strategies to ensure they can do that. And they know how to depress the price of an equity. They know how to do all these things. So um, what should happen isn't what will happen much of the time. So keep that in mind. And maybe later I could do a video about getting X amount of put options, which is generally a smaller amount as a hedge, against the risk if you're investing in something that's incredibly risky, and things of that nature, kind of covering yourself, trying to mitigate risk with an option, right? So I guess that's all I have for now. I hope you have a great day, and I'll see you on the next one. Peace.